In recent weeks, we have seen a couple of established trends relating to two of the most heavily traded currencies challenged. The dollar has on occasion been reacting positively to bullish US news, whilst the yen has deviated from its upward path. Michael Hart has an impressive CV and is currently the Director of FX Strategy at Roubini Global Economics, and he joins me now. Michael, are we witnessing a change in the relationship between the US dollar and risk?
Yeah, I think we are again undergoing one of these recurrent regime switches that we've observed throughout the period since 2008, whenever we had a somewhat prolonged stretch of good news. And what happens then is that we switch out of this risk-related trading pattern and into back towards the more fundamental drivers, activity indicators, the cyclical outlook, and rate differentials. And that's been very much in evidence in March in particular, when we had the first results of the U.S. bank stress tests. That really fueled a rally in the stock market, which then in turn sparked a sell-off in bond markets in the long end, in particular in the 10 and 30 years. And that in turn has rocketed, has put fuel under the dollar's fire. And so very much at the moment, we seem to have switched back towards the cyclical trading regime.
There have been a lot of bullish releases relating to the US economy this year, but many are expecting news from the US to soften. Where do you stand on the matter?
Yes, we do belong into the camp of people who think that the current recovery is not sustainable at a strong pace and will remain sub-trend for quite some time. Our growth forecast for the year is just about 1.8%, the trend rate, and about the consensus is about 2.5%. And there are a lot of headwinds for the U.S. economy, the fiscal drag being one, the deleveraging by consumers being another important one, and the structural changes in the labor market as well. Plus, sort of headline risks from one of three flashpoints, be it a sharp deceleration in China, a flaring up of the Eurozone crisis again, or a sharp spike in oil prices. These are all elements that constitute the downside scenario. But for the time being, we do extend for this rally to extend a couple percent more before sort of stalling, and then we may get to a situation where the anemic type of the recovery we're under does prompt the Fed to soften its language again, perhaps paving the way to another round of quantitative easing, which could look quite differently than the previous one, but still would be an operation that would withdraw some support from the dollar.
So if we do see a more bearish US economy towards the end of the year, how would you expect the dollar to react? Will we go back to the established relationship between risk and the greenback, which we have seen since 2008?
I think we could shift back to that, but it also depends very much on what happens elsewhere and how this change in market sentiment comes about. If it is due to a deceleration in U.S. economic activity and nothing but that, it would be negative for the dollar. But if it is a flaring up of the Eurozone crisis, say because Portugal needs a program augmentation or starts talking about restructuring, then that could be a positive for the dollar, as we would then see reflows into safe havens. A China slowdown would again be something that affects global growth, but would not necessarily be affecting risk sentiment, again holding everything else constant, and that would have a more ambiguous effect on the dollar. So it very much depends on the specific circumstances in which this takes place.
Now let's move on to the yen. Over the last couple of years, the yen has been appreciating steadily, but has bucked that trend in recent weeks. Why have we seen the yen weaken, particularly against the US dollar?
Well, I think there is a strong fundamental undercurrent, which is, demographic change that's taking place in Japan, which means that savings are declining, and that in turn means that the stock of foreign assets that Japan holds will diminish over time and decrease the investment income that Japan earns. And what that means is that the current account surplus will be shrinking over the next few years. That, however, is a very slow-burning and long-term development that I don't think was really, the catalyst for this sell-off. There was a little bit of a canary in the coal mine in the form of a trade deficit for 2011 that was released, and that was part of the trigger for the sell-off. But I think that is very much due to specific factors of 2011, in particular the need to import more mineral fuel. So that's not really part of that long-term phenomenon that I mentioned. But together with the other element, which was the announcement of an expansion of the Bank of Japan's QE program, is what triggered the sell-off. Now, in our view, there are some reasons for yen to back up a little bit, but we don't see a move like some commentators do to a dollar-yen rate of 90 or even 100 on the basis of that. The move by the Bank of Japan expanding its QE program may be brave by its own standards. It's an expansion by some 50%, but really compared to what other central banks are doing, isn't very impressive. If you compare what the Bank of Japan plans to do by the end of this year and its pre-crisis, the pre-crisis size of its balance sheet, and that's an expansion by about 40%. And as you know, other central banks like the Federal Reserve, the ECB, the Swiss National Bank, or the Bank of England have doubled, tripled, or even gone further in expanding their balance sheets. So really, that too for us is not sufficient reason to drive the yen much lower.
Well, thank you, Michael. Michael Hart speaking to me there from the London offices of Roubini Global Economics. There's much more to come here on Dukascopy TV, but for now, goodbye.